Analysis and interpretation of information. It's very important to interpret accounting information once it has been produced. Remember that this is actually the purpose of our accounting records, to provide information. If we then don't make sure that we thoroughly understand it and interpret it for other people, it is pointless going through the entire accounting process, from source documents to recording our records in the books of prime entry, to posting to the general ledgers, creating trial balances and financial statements. If that is all that you do, it's really not going to achieve very much. Once the financial statements have been prepared, it is vitally important that they are looked at very, very carefully in order to try to understand the business activities a little bit better and then be able to give advice to the people concerned. The recording process must be followed by this interpretation, firstly, so that you can try and identify where possible problems exist, so that you can then move on to try and make suggestions for that. Once you've identified the problem, you need to also identify the cause of the problem. Once you've identified the cause, you might then be able to find a solution in order to solve this. The comparison is very, very important in order to determine whether the situation has improved or deteriorated since previous years, as well as with other businesses, in order to see how your business is actually performing. Once you've done the comparisons, then it is easier to identify the problems, the causes, and suggest possible solutions to the people who need this information. Firstly, let's have a look at working capital. By working capital, we mean our current assets and current liabilities. The working capital cycle looks at the inventory turnover period as well as the average collection period less the average payment period. In other words, how long does it take your inventory to sell? Then, how long does it take your customers to pay you? And you compare this to the amount of time that you have to pay your suppliers. Where you are able to keep this working capital cycle as low as possible, it means that you won't need as much working capital. For example, if you are able to sell your inventory very quickly and get the money from your customers faster than the time that you need to pay your creditors or your suppliers, you're not going to need any working capital. On the other hand, if you are buying everything for cash, and it takes a while for you to sell your inventory and your customers take a long time to pay you, you are going to need a lot of extra cash to finance this. Ideally, you therefore want to keep this working capital cycle as low as possible. So we're referring to the number of days here. Let's now have a look at the net working assets to revenue. By net working assets, net obviously means you want to subtract your current liabilities, and working assets is referring again to your current assets and your current liabilities, but particularly your inventories, your receivables, your payables. Notice that cash is excluded from this. So you're trying to see from your working capital, excluding cash, what percentage is this of your total revenue or sales. So the easiest way to remember this one is simply to think of it as your working capital without cash compared to your total sales. This then tells you how much revenue is actually tied up in your non-cash working capital, and ideally, again, you want to keep it as low as possible. The higher your working assets, particularly compared to the sales that you are generating, it means the more working capital you will actually need for this. Gearing. Gearing refers to how much capital employed is borrowed versus own, in other words, from the owners. Capital employed, remember, is your total financing of the business. So the money needed to actually start operating, where did it come from? Did you borrow a lot from the banks, or did you put a whole lot in on your own? The more money that is borrowed, the more costly this exercise will be, as you need to pay interest on any borrowed monies, and also the more risky it will be, as you don't have as much own capital to suck up the costs of losses. If you have got more money that is being borrowed, it means that you have a higher risk of possible bankruptcy. We'll calculate this using our income gearing as one ratio, and income gearing basically looks at what your interest expense or your finance costs are as a percentage of your profit before interest and tax. In other words, your operating profit after investment income. So this is looking at how you are able to cover the financing that you need for your business from your profits. You will compare it to previous years, and then hopefully it's not too bad. The lower, the better. The gearing ratio refers to how much money has been borrowed, or also the capital on which there is a fixed cost. In other words, obviously loans from banks would have a fixed interest attached to them, but in fact over here we are also going to take into account any preference shares which have a fixed dividend, because we have to bear the cost of that. So you'll look at all your capital that has a fixed cost to it and compare that to the total capital that has been employed, or the total financing that was needed by the business. So in other words, to put it in a slightly different way, you're going to look at all your non-current liabilities or loans, as well as all your preference share capital, and compare this to your non-current liabilities and equity in total. So this determines then your degree of borrowing and risk for this particular business, and usually it would be considered safe if it's a 50% or lower ratio. If a business is considered to be lowly geared, in other words lower than 50%, it would mean that it is seen to be more creditworthy in the eyes of banks, and as a result it would generally be easier for a business to get new loans. We're now going to look at investment returns. In other words, where you have companies where there are shares on the stock exchange, it's very important to have a look at the earnings per share as well as the dividends per share. Remember that the earnings would be the profits of that company, and the dividends would be the profits that have been paid out. So these two are very closely related but are not the same. Firstly, let's have a look at the price-earnings ratio. This ratio is important for investors considering buying shares, as it looks at the market price of the share and compares it to the earnings or the profit that has been earned. Notice this is not looking at the dividends, so it's not looking at how much cash you would get out, but rather how that share will actually earn profits and therefore possible growth of the business. The market price per share is looking at what it will cost you to buy a share today, and therefore how long it will take you to pay for the price of that share based on what its earnings are. So very simply, it will calculate the number of years' profits that you need to pay for the share if you had to buy a share today. You can compare this to previous years as well as to the price-earnings ratio of other companies. Obviously, the shorter the period, the better. If there's a very high ratio, it means that the investors are very confident in this company. The earnings per share is very simply the net profit that is attributable to ordinary shareholders divided by the number of issued ordinary shares. Keep in mind that I said net profit attributable to ordinary shares, so you need to first remove any preference share dividend. In other words, you're kind of treating your preference shares a little bit as if they were liabilities rather than equity. They are equity, but remember that when we were looking at gearing, we also excluded, or we looked at the fixed cost capital, and in fixed cost capital we lumped the preference shares together with non-current liabilities. It's a similar concept over here. This is going to determine what profit has actually been earned by each ordinary share, and again you would compare it to previous years as well as what the dividend per share was for this particular year. At the same time, you therefore obviously need to calculate the dividends per share. The dividends per share is the ordinary dividend that has been declared and paid for a particular period divided by the number of issued ordinary shares. This then should be compared to both previous years as well as the earnings per share that has just been calculated. The difference between the earnings and the dividends is going to obviously be the income that has been retained for future growth. The dividend yield looks at what dividend has actually been paid and proposed for the year, and this is then compared to the market price of the share today. In other words, what would you pay for a share today, and what would the actual return received be? And investors would want to see this, particularly if they are reliant on that investment income. You would then compare this to other investment returns. Dividend cover refers to the profit that is available to pay the ordinary dividends compared to the ordinary dividend paid. In other words, you would look at your retained earnings. How much is actually available to pay the dividends? And this determines how easily dividends can actually be paid in the future, and you would compare it to the dividends cover of previous years as well as for other companies. And this will also indicate for you how sustainable this particular business actually is in relation to paying out dividends. If there's a very high cover, it would be because of relatively low dividend payouts, and this indicates that dividends in the future will be very sustainable. If the cover is very low, it indicates that there may be a likelihood of less dividends in the future.